Welcome everyone to our LinkedIn Live. I'm Bruce Eckfeldt. I'm going to give you a little overview of things. I'm going to introduce our guests and then we'll get going. So our session today is an interesting one. It's scaling smarter, so strategic growth through acquisition. We're going to talk a little bit about kind of the decision of using acquisition as a growth tool, and kind of the trade-offs and some of the things to consider, and then the actual acquisition process. What is this like? What are some of the things you need to know? And then a little bit about what we see going on in the market right now. We're kind of in interesting times with obviously political situation, the world kind of situation, economic situation, interest rates. Those are all things that are kind of driving the M&A market right now, particularly in this kind of mid-market. So we're going to talk about all those, hopefully give you some insights, some ideas, and maybe get you thinking a little bit about how to use acquisition in that space. Before I kind of introduce our guests, let me cover a couple of housekeeping things. So we're here live on LinkedIn and as well on YouTube. If you have a comment or a question, go ahead and drop it into the chat on LinkedIn. I'll be watching those as we go. I'll try to weave in comments and questions that come up. If you're on YouTube, go over to LinkedIn. I'm not going to be watching the YouTube chat live here. If you're watching the replay, go ahead and leave a question or a comment either on LinkedIn or on YouTube. We'll be watching those in the coming days, and we'll try to reply to those. So even if you're watching the replay, go ahead and engage there because we will be watching that. We can answer questions and reply to things there. So let me introduce our guests. First up, I've got Neil Schaefer. He is a growth strategist and an author specializing on innovation and deal structures. He's got a background in corporate finance and strategic partnerships. Neil has advised numerous companies on leveraging joint ventures and alternative financing to drive growth efficiently. I'm excited for this conversation with Neil. Neil, welcome to the program.
Oh, thanks, Bruce. Pleasure to be here.
Yeah, it's a pleasure to have you. Next up, we've got Laura Crothers. She is an expert in organizational design, leadership development, and specializes in aligning people and culture with business strategy during times, particularly around rapid change. Obviously, a big challenge for a lot of companies that are growing quickly. She's done a lot of work in mergers and acquisitions. She led mergers and acquisitions around the HR space at S&P. She's worked with companies on both the buy and the sell side of transactions. With all that, Laura, welcome to the program.
Thank you, Bruce. I'm happy to be here.
So let's get into our questions here. Let me start with just kind of a general one, which is when you are working with companies that are looking to scale and they're trying to figure out, hey, should I continue to organically grow and invest in my current operations and sales and grow the business organically versus looking for strategic opportunities around acquisition to drive growth? What are a couple of factors that are really important to you that you really need to ask, or questions you need to ask the business? Laura, why don't we start with you on this one?
Sure. So for me, the questions a lot of times align around talent and what their current talent is like, and do they have people that can scale if they have an acquisition that's going to double their size, right? Do they have talent that can grow at that level? Looking at if they have some gaps in talent, might an acquisition be able to help fill those gaps or that succession plan? So that's one of the things we critically look at, is kind of that leadership level and then the next level below to see what kind of talent is there and what might be needed from a talent management and development standpoint.
Yeah. Neil, what's on your list when you look at kind of making that decision?
Yeah, I'm going to amplify and expand on Laura's answer a little bit. I think talent is one aspect of, quote, capabilities that I tend to look at and really look at, I think acquisitions are a great way to acquire new talent and to really force a company to assess their leadership team and try to fill those gaps in those kind of capabilities. But it's also product capability, technology, market penetration. You look at sort of the entire array of where a company is and where it intends to go, and then see whether going to that place and building out those assets organically versus inorganically is the, if you will, the fastest and most efficient way to accomplish that goal of trying to scale to the next level.
Yeah. I generally find it's kind of this some level of combination of time and risk, right? Like, does the acquisition, get me where I need to go or where I want to go either faster or, take a bunch of risk off the table that I would otherwise have if I'm trying to do it myself. And yes, there's opportunities around market, geographic acquisition, or kind of service lines, or capacity kind of things. But in the end, I find that it's kind of this risk and time. Like I'm trading things off around those, and obviously the money. When you're working with companies on kind of evaluating or trying to identify what an acquisition would look like how are you kind of helping them frame the target around an acquisition before you kind of actually go out to market? Are there things that you're kind of putting parameters around in terms of, okay, well, an acquisition needs to do A, B, C? Like how do you help create some criteria for the business to understand what they might be looking for? Neil, why don't we start with you on this one?
I think that it starts with a strategy evaluation and a really careful look at a company's kind of where they play and how they win and what they intend to do in the future and what systems and process and people support that approach. And then usually there'll be a gap between their intention and their current state, their current realization, and then working through that gap analysis and that capability and that differential and say, this is what you're trying to accomplish, and these are the resources you would need to have internally to accomplish that. So I'm focusing much more on the resources required to bring in versus the resources consideration you're going to spend out to get them. Yeah. But the targeting process, after you establish what you're trying to accomplish with a great deal of rigor and precision, targeting then becomes a much easier exercise because they're really clear about what specific things you're trying to attain. Yeah. If it's, and going through, whatever that may be, then you go through that process of, do I want to build it myself? Do I want to take the time and the energy, and am I able to build it? Or do I want to try to identify an entity in the market, whether it's a competitor or an adjacency or a distributor or a supplier, depending on what I'm trying to obtain, going about targeting that entity. And usually the thought experiment that I do is to ask my clients what they would like to buy, who they would like to buy, what business they would like to acquire, if cost or access to capital were not a consideration. Yeah. Pretend you have the magic pencil. What would you do?
Yeah. I find that there's a lot of, or it's not uncommon to kind of this shiny object syndrome where like a business sees this, hey, there's this business here that wouldn't it be great to kind of, acquire them or kind of fold them in or do something with them, without really kind of understanding what their needs are prior to going to market. Laura, I guess what would you advise clients? What do they do? What do they need to do and kind of figure out for themselves before they actually start looking at companies so that they're clear on, all right, what are we really trying to achieve and what does success look like?
Yeah, I mean, it's a lot of what Neil said is understanding where those gaps are clearly and putting together where their strengths are. Because part of it is also, what do they have to offer the companies that are looking to potentially come in? So getting really clear on what your value proposition is. Why would people want to join you? Yeah. Both leaders, as well as getting employees to stick after an acquisition, and getting clear about what are the things that are non-negotiable for you. So here are things we must have or we will do that, really getting clear on that. What are those things? Because that's helpful. The more clarity you have up front as you entertain those discussions, you're all aligned from a leadership team standpoint.
Yeah, I find that all the time. It's like if you start trying to figure that stuff out during the heat of the deal, you make bad decisions because you're trying to get a deal.
It depends upon who they're talking to. The CFO says one thing, the CEO says something, the business development guy says something else, and then and then you're in some internal debate. So it's getting that alignment and clarity up front from a leadership standpoint.
Yeah. So say you've done that kind of pre-work and kind of figured out, okay, what are we really looking for? How is it going to help us? What do we need in acquisition? How is it going to get us to our goals? How do you actually start going to market? Like once you have kind of a general idea of what you're looking to acquire, where do you start? Because I think a lot of founders and a lot of CEOs of these mid-market companies, it's like, yeah, great idea. I would love to acquire someone that is in this market or has this capability or has these technologies, but where do I begin to even find these things? Laura, why don't you start with that one?
Yeah, I mean, so for us, we're not the people who are going to help them find that, but they've got to find the right partner, whether it's, investment banker or a broker or someone. They have to find that right partner. And one of the things that I say to founders as they get to that point is you need to interview a lot of people. Just because your friend says, they use somebody, don't just do that. You need to interview a lot of people and see who you're comfortable with, who aligns with you, who's done deals in your space, how well do they know the space, do they know the multiples, do you have evaluated, blah, 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 all that kind of stuff. So finding the right partner would be the next step if they haven't already identified that person years ahead, because a lot of them have had that relationship for a long time, so they know where they're going to go when they're ready.
Yeah. Neil, where do you give us some ideas for founders that are or CEOs looking for that?
So normally when I do my M&A workshops, I'll take leadership teams through a 7-stage process and really inform them about where kind of how the M&A process works.
Yep.
And it really starts with strategy and blueprinting and understanding your objectives and really being clear about themes, valuation, size of company. Do you want to buy something that's 10% your size, 30% your size? You really need to start to go through
200%.
Well, sometimes 200%.
Yeah, exactly.
But probably not, my suggestion is probably not on your first deal.
Not on the first, yeah.
Something about going through this and if you will, and going
start with the 5K before you do the ultra marathon
in a sandbox. But really, helping them through thinking about the search process, how they qualify, what kind of capital they need, where capital could come from. Thinking about integration issues, thinking about cultural issues, going through who has to get involved in which of those stages. For folks that have not gone through acquisitions in the past, very often they don't, Laura, I agree with you about needing to interview multiple bankers and other sources. They very often have never hired one before. A lot of the folks that I'm talking with really don't have experience and don't quite know what the criteria and what that, scorecard even looks like. So helping them through identifying the types of bankers and what kind of experience and what kind of skills and what kind of market understanding and awareness they have, and then helping them understand how to go about evaluating an investment banker is part of the process.
Yeah.
But I lean very, very hard into the two areas of really the success and failure factors, which are successful integration and successful valuation. Not overpaying and making sure that you spend a lot of time on thinking through cultural integration and people, process, systems, technology integration. Almost as soon as you develop clarity about a target and you're preparing to issue a letter of intent to acquire a company, start going really deep into integration. And that really starts with the leadership team and the CEO. You don't delegate that. A big success factor is don't delegate that.
Right. And I think you're also looking for in addition to the banker or that kind of advisor, you want to have the right lawyer on your team too. And so I've seen that as well, where they've had someone who's been their lawyer for the business, maybe on contracts, really mostly contracts and general duty. And they're like, oh, I'll do your deal. And I'm like, okay, maybe if it's a tiny one, but if you're going to do anything substantial, you really want a lawyer that this is what they do day in and day out, and they know the nuances and they can really help you negotiate.
Yeah.
So getting that right partner as well, like getting the right people on the table.
Getting the right team in place.
Yeah.
Or super important. The legal contribution into this process shouldn't be underestimated. It's really, really important that you have, a surgeon who's done this kind of operation many, many times in the past.
Someone asked me the other day, couldn't I just do this on legal Zoom? And I was like, well,
you could. No, don't.
Yeah,
that's a red line.
Yeah, I don't know where to go with that one. I'll throw in there as well. I think the accountant is actually almost maybe not quite as important, but is definitely up there. And similar to the lawyer, you want an accountant, you want someone who's been through this process, because your standard, kind of general day-to-day accountant, probably doesn't have the level of deal experience to evaluate businesses and kind of do evaluations and do valuations, right? Like that is a pretty particular way of doing things. And I've seen this a couple of times where a good accountant can really kind of get into the books of a target and really tell you, okay, what's going on in this business, and is this going to really serve you the way you think it's going to serve you? Are they really making money in these areas? Where are their cost structures? And particularly if they know your books, they can do a great analysis to be able to say, okay, look, you've got, this is where your overlap is. This is where your duplicates are going to be. This is where your where you combine things for value. This is where you're just going to have to shed things because you don't need two of this stuff, right? And they can do a good analysis of, not only the valuation, but understand the business, but then merge it with yours and kind of figure out, okay, where is this really going to achieve what you want from a financial point of view and a growth point of view? So we mentioned risk a little bit about some of these things. What are the key things you really kind of need to be aware of or look out for in terms of where these deals either don't get done, right? We're in diligence and we fail to close for some reason, or we close, but we fail to see the integration or the real kind of synergies that we hope for. What are some of the things that typically come up and that you be aware of, and how might you kind of diagnose those things earlier? Neil, let's start with you on this.
So you touched on a really important one, Bruce, which is the quality of earnings and the quality of the performance of the target company, and being able to diligence that very effectively to know whether the information that's being shared is in fact true and accurate, and to the extent that and then take the next analysis of looking to bring the two companies' financials together and what a combined company would look like on a forecasted basis. Thinking about, to your point, the duplication of effort, the duplication of roles, how to choose, which talent stays with the company, and how to how to think about particularly leadership transition. And we're not, I'll just touch on, capital sources for a moment. One of the very best ways of, accessing capital inexpensively to do acquisitions is to use your own equity if you can. It's really, when you talked before about what is the company offering to the target, how do they, how appealing is this company for the staff and the executives who are going to come on board? One of the ways you can really get underneath that is you're going to position this as using your own equity to some extent and as consideration for the deal. If they love what they hear about joining your company, they'll be much more willing to accept equity, even if it's not liquid equity, very interested in taking equity as part of their consideration if they really believe in the mission of your company and the power of what they're joining into.
Yeah. Laura, what are some of the kind of risk items on your list, and how do you kind of diagnose them or help suss them out early in the process?
Yeah, so from an HR and leadership standpoint, we're going to be looking for cultural alignment. So looking closely at cultural alignment, looking at even things as simple as handbooks and benefits. Are there any risks there in putting those kind of policies together? Are there risks in the way that you operate? Like, I can think of companies that are, buttoned up and Wall Street-ish that want to acquire a Silicon Valley kind of company where they've got the dogs in the office, they're coming in jeans, they're working at midnight, they're not in till, maybe 2 p.m. they show up. That's a real cultural mismatch. So really thinking about what do you want with this? And how are you going to do it? So that's kind of a cultural one. And then we look at compensation structures. We look at different risks. Are there legal risks out there? Are there things that are out there? What is your turnover rate? At the acquisition, what kind of things are engagement surveys? So the more data you've got up front, will be able to highlight where things are going well and where there might be some risk. So from an HR standpoint, there's so many things. we look at, but I'd say the biggest things that I see with deals falling apart are cultural misalignments, and something that was hidden that they thought, well, maybe we're going to get this figured out before they come, this employee relations situation, and they're working through the situation. And then all of a sudden, right before the deal closes, somebody files a lawsuit. And then you're like, well, how long has this been going on? You might not have had a lawsuit, but something was there. And so then you get into like potentially now you've got a trust issue, because the acquirer is like, well, I know it wasn't a lawsuit, but you've been dealing with this for 6 months. Why didn't you at least tell me we're dealing with this situation and we're hoping to have it resolved?
Yeah.
Right. And so then I see trust start to erode.
Yeah. Sure. Yeah. One of my general kind of philosophies and kind of rules of thumbs when I'm working with companies that are prepping for exit is I call it the skeleton list. We can make a list of all the skeletons in the business, and we put that on the table up front.
Sure.
And we just say, look, here are all the things you need to know. And it's fundamentally for the trust issue, because if I come to the table and disclose all the potential hair on the deal up front, and we start working through it, and no other things start coming up, they start trusting the process. Now they're going to trust everything else. My numbers, like my client representation, like my financials, like they're going to be much more willing to kind of do a deal. And the thing is, the buyers know there's stuff out there, and they're waiting for it, right? They're just waiting to kind of wait. Like, we don't know what it is, but it will come up, and then we'll have to make a decision.
Yeah.
And if it's like, if there's hair on the deal, I'd rather know up front. If there's something on that list that someone says like, I'm sorry, I can't do this deal. Great. We've wasted lunch.
Yeah. Right? Now, there's certainly this no surprises rule in deals. It's, the full disclosure, no surprises, get ahead of all the things that could come up at the end, and don't force the buyer to uncover things that that the target should have disclosed. To your point, it erodes or it enhances trust depending on how you deal with disclosure.
Yeah.
I think the other risk, the other thing that I think a lot about, especially with companies that are looking to acquire businesses in other markets that are remote to their business, is how they're going to go about managing that subsidiary company in a different market. What's the reporting structure? How are we going to make sure that they can make decisions independently but inform the head office properly? What does that relationship look like? How do you want that to behave?
Yeah. All big issues. Let's talk a little bit about the market in general now. Like what are we seeing, I guess, in kind of mid-market M&A? I know there's kind of been ups and downs, interest rates, economic situation, tariffs, political changes, right? Like it's kind of an interesting world right now. Well, I guess give us the last year or so, and what are you seeing recently? Laura, let's start with you. I know you've been to some conferences recently.
Yeah, so we're seeing an uptick in the last couple of months. A lot of lawyers we're talking to are in the middle of diligence with people or penning deals. A lot of companies are trying to close by the end of the year. We're still seeing a lot of roll-ups. So maybe, a private equity firm, for instance, will have one company that they've bought as the platform already, and they're looking to continue to integrate other companies into that. So I'm seeing a lot of that in the professional services world. But we're definitely seeing a little uptick as we get into this last quarter of the year, which is nice.
Yeah. Neil, anything on your side?
I'm seeing more enthusiasm and more optimism around a reducing interest rate expectation over the next year or so. It'll help the debt markets. It'll help private equity funds and other borrowers be able to make their model work better and put less equity into their deals. It's certainly there's trillions of dollars of dry powder between venture capital. I mean, we're into the trillions now of money committed capital sitting on the sidelines waiting to be deployed. Most of what I'm seeing is very similar to what Laura is describing. A lot of it's roll-ups of professional services, roll-ups of companies that have figured out how to have recurring revenue and move away from pure project revenues. That seems to be very, very appealing to most of the private equity roll-up that we're seeing in the marketplace right now.
Yeah.
And I think the the other challenge is very immediate, which is if the SEC actually shuts down tomorrow, along with the rest of the government, that's going to put a bit of a wrinkle into venture capital investors' expectations of IPOs that they were hoping were going to happen in the fourth quarter and into early next year. That could, stopping that process, even if you try to turn it back on 3 days later, you're going to have some preparation and make ready. And there's going to be a delay inherent in that, unfortunately.
Yeah,
it's definitely
I'm going to add one thing, Bruce. I forgot, I was talking to a client yesterday who they happen to do a lot of H-1 visas.
Oh, yeah.
Right. And so now they're going to charge $100,000
a pop now. Yeah.
So this, he was saying to me, I think we might have to do some internal acquisitions because we've been doing, this visa approach for a while, and there's not a lot of talent in the US doing what we do. So we might need to buy another company like us.
Yeah. Interesting.
Yeah. I'm just kind of curious because I agree. There's a lot of dry powder. There's a lot of demand. I think people want to buy companies, and now they kind of can. Interest rates a little bit better. They're seeing a little stabilization on kind of international trade and things like that. How does that change the seller's approach? If I'm a company, I'm interested in selling. How does that change the seller's approach to this market at this point? I don't know if either of you have thoughts on that one.
I do. I think that I'm not looking at this as a momentary thing. I'm looking at this as a 10-year trend. And I think that we're in a buyer's market and it's going to strengthen over the next few years.
Yeah.
I really emphasize with companies that if they intend to sell their business, there's going to be a lot more supply than there will be demand going forward. And the strong ones will prevail and they'll be sold for value. And the weak ones many of them, unfortunately, will fall to the wayside and not be able to execute transactions. The other thing that I worry about, frankly, is with all the disruption in the world that you sort of identified a little bit of, Bruce, businesses are starting to feel like there's going to be a fair amount of headwind for the next couple of years, and the expectation of 10 and 20% revenue and earnings growth that companies were experiencing for the past few years, they're now facing some headwinds where that's going to be harder to accomplish. If you're I want to look at 3 years of increasing revenue and earnings as I look at historical financial statements, and then all of a sudden you have we're down 15% this year, that's going to have real impact on valuation.
Yeah.
And then the next question is, what else are we trying to value, and where do we find value in multiple expansion if it's not in our financials? What else do we have to pay attention to in terms of the structure and the nature of the business, talent, lack of concentration? Like, where else do you have to look for value creation if your revenue earnings are taking a bit of a dip?
Yeah. Certainly finding some strategic value, right? If you can't just find pure economic growth value, it's like, okay, how do I figure out where is my kind of unique asset or capability that I have, and who could really use this? Yeah. It's kind of finding that match. Laura, anything you've seen in terms of kind of from the seller point of view, what it changes their approach?
Yeah. I think that we've got a lot of baby boomer aging things, and they're looking at successors that are potentially either within their family, or do they need to look at some other kind of successor? So I've seen that with sellers saying, hey, maybe this is, a better exit strategy than the one I thought I had planned, as my next gen has come up a little bit. This isn't really what they want to do or what they're going to be great at. So maybe this is a better strategy. So that's one I feel like I've heard a lot more of.
Yeah.
And then preparing.
Yeah.
Right. And so from HR, really doing the engagement surveys, doing all that stuff. So you've got a good story to tell if you're a people business.
Yeah. Yeah. The general recommendation I give to selling founders is, like, figure out what you're going to do next, get yourself ready, be able to move quickly if you need to, be able to hold it for a little while if we need to, but just trying to really time the market is hard. And the other thing is you just need one deal, right? So even in a down market, you can find a great deal. And even in the best market in the world, you may not be able to find a deal just because of your situation.
No,
so
that's a great point.
The timing is kind of hard. We're going to hit time here. I want to make sure people get contact information. Laura, if people want to get a hold of you, what's the best way to do that?
So you can reach me at laura@CrothersHRconsulting.com or go on our website. We've got a bunch of phone numbers and info you can find there. It's Crothers HR Consulting.
Excellent. And Neil, what's the best way to get a hold of you?
So it's Neil@CarltonAdvisorsLLC.com, and that is also the website. It's Carlton Advisors LLC, and you'll find all of our contact information and background is there as well.
Perfect. And if anyone is get a hold of me, Bruce@eckfeldt.com. Eckfeldt.com is my my website. And then obviously we're all on LinkedIn here. You can click on there. And again, if people are watching the replay here, go ahead and leave comments and questions. We'll look at that and respond to people there. But Neil, Laura, thank you so much for joining me today.
Oh, thank you, Bruce.
Thank you. This has been great fun. Hey, good luck everybody in the markets.
Make
some deals happen.
Thanks everyone for joining us. Look forward to having conversations and catching up with folks, and we'll see you on the next program.
Great. Thanks again.